Good evening all. Welcome to this evening's seminar. Thank you for joining us. The focus of today's seminar is to allow you as business owners or accountants of business owners to understand, whilst you own your business, what are the most tax efficient ways of extracting money from that business so you have enough personal wealth to enjoy your best life. Or if you are fortunate enough at the end of your period owning a business to sell that business, how much do you need to sell it for to achieve financial freedom? During this webinar, Nick will first discuss what financial freedom means and how to calculate that for you. Declan and I will then go on to explain how we as financial planners can help you and your clients by showing a client scenario and the tools that we use to quantify their situation. Declan will then explain the bucket concept, and then we will look at ways in which you can extract money tax efficiently from your business whilst running it and other financial opportunities that may be of opportunity to you. Just to clarify at this stage, the webinar is designed to give you an overview and a holistic approach, and any financial advice strategies should be taken within accordance with the regulated professionals. We will then look at how to value your business and what that means for potential buyers. And then finally, we'll answer any questions you have. So firstly, I'm going to pass over to Nick, who will introduce financial freedom.
Yes, good evening, everyone, and thank you for joining us this evening. We hope to complete this webinar in 40 minutes. So it's a pretty whistle-stop tour of how business owners should be focusing on accumulating monies from their business, which should be their ticket to financial freedom. I established Henwood Court in 2004, and we built a fairly sizable lifestyle-based chartered financial planning firm designed largely around servicing successful established business owners and helping them to understand what their best life looks like, to cost that, and build a financial plan and strategy for them to accumulate wealth to achieve that. And predominantly to allow them to accumulate sufficient funds that they got enough for themselves and hopefully their families as well. Financial freedom is a topic that's very close to our hearts here. And what is financial freedom? Financial freedom is the ability to live the life that you want to live, that you desire, without having to generate any income from your working activities or your businesses, the case may be for the attendees here today. So it's having that financial freedom, what we call your FU number, to be able to do the things that you want to do without having to work. So for many people, that's exiting the business, retiring, and living off your accumulated liquid wealth. For some people, it's continuing to work, but no, you've got that peace of mind that you don't need to, but you choose to. How we calculate the fund number is quite easy, really, but again, to keep this fairly basic, we basically take the income that you need in retirement, multiply this by 20, take away any fixed income that you may have, i.e. from state pensions, for example, and then add any one-off costs that may be incurred in later life. So, for example, if someone requires 50,000 per annum to maintain their lifestyle, we'd multiply that by 20, giving us £1 million. And if they're planning to spend £250,000 on a property in France, that gets added to that £1 million. So their fund number is 1.25 million. And we base that on experience of having looked after, clients myself for almost 30 years. The experience I've had is with that kind of wealth, not only does it meet the needs and requirements for people, and it is enough, but often their wealth does actually accumulate, despite us encouraging people to spend, or if they can't spend, to gift that monies away. So today is all about financial freedom and how our business owners can accumulate sufficient wealth to achieve their objectives. And Declan's now going to come on to just explaining a few other things alongside Matt in terms of a case study of how we actually work with clients to achieve financial freedom for themselves and develop sufficient enough monies for them. Over to you, Matt.
Thanks, Nick. That's great. So what we're going to do now is run through a client scenario. A business owner, like many, who's got a very successful business, has spent years focusing on the value of his business, the funds within the business, but without truly focusing on his own personal wealth and throwing money over the wall. And by this, I mean extracting money from the business tax efficiently to allow him to enjoy financial freedom without needing to sell the business. And then if he does sell the business, even better. Our job as financial planners here at Henwood Court is to understand you. It's not about money. Money is merely a facilitator to allow you to live your best life. We take all our clients through the Financial Sense Discovery Programme. And during this, we take some time to get to know you, your background, and then to create a sort of wish list of your hopes and dreams. We do this because it's not possible to give someone proper financial advice without firstly understanding them, their values, life goals, what's important to them, and the past experiences they've had with money. This element of our work is essential because it helps foster greater financial awareness of your position and objectives and does the initial groundwork to ensure that any product solutions are totally geared and mobilised towards the achievement of your stated objectives. The client scenario we shall work on today is John and Andrea Jones. They've come to us because they're reaching an age where John is considering retirement, but doesn't feel ready at all. So if we look at their situation, they're married, early 50s, they've got 2 children, Tom 18 and Laura 19. John is sole owner of Widget Limited. It's got a turnover of 5 million and a net profit of £1 million. It's got 750,000 in the business bank account. Andrea does not currently work and hasn't done for the last 5 years. They've got gross household income of 259,000, which is made up of salary, a small salary, and the remaining dividends, which nets to around about 179,000. Their annual expenditure is approximately 130 to 140,000, and they've got 30,000 in cash deposits. Their main residence is worth £1 million with a £500,000 mortgage, and they've got 2 other loans and a credit card. John has a standard life pension worth 300,000, which Widget Limited are contributing £500 per month to. They're the hard facts. They're the things that we know, but the soft facts are more important. This is about their feelings, their drivers, and what's sort of keeping them up at night. So if we look at those, Johnny's worried. Will he ever be able to retire? And what does he need from the business to enable that? Andrea feels like John works far too much and is very stressed. And John dislikes paying tax, both personally and through Widget Limited. He'd like to become more tax efficient in both areas. Andrea hasn't saved into a pension since leaving the NHS, and should she be? And John feels he's dedicated his life to Widget Limited and feels like he wouldn't want to let that baby go. And Andrea worries that their retirement dreams aren't realistic at this stage. And both feel they're financially disorganised and have no plan. What we're going to look at now is Declan's going to run through the objectives that John and Andrea went through whilst discussing their situation with Declan.
Thanks, Matt. Crucially, may I start with this? We are lifestyle financial planners. Lifestyle financial planning, as Matt said, goes beyond what traditionally looking at, which is wealth, assets, net worth, and valuations. Instead, it looks at trying to understand what really matters to clients, what their most pressing financial concerns are, identifying and capturing the things they want to achieve in their lifetime, and also finding, I guess, what they want to do in the next 5, 10, 15, 20, or 30 years' time. Let's look at Mr. and Mrs. Jones' objectives then. These are the quotes we captured. We love the Algarve and dream of buying a holiday home there one day. I want to exit the business in 8 years, retiring completely, to become debt-free by retirement. We will continue to support Laura at university and plan to do the same for Tom. We know how hard it is to buy a house at the moment, so we plan to give both children 50,000 aged 25. We love our house. I cannot ever see us moving. To build sufficient personal assets for our retirement. Ability to fund and maintain our ideal lifestyle, both now and in retirement. Right, now we'll move on to the cash flow software. Just bear with us while we load that. Okay, this is coming up on my screen now.
Yeah, sorry, Declan, just having one technical glitch. We'll be with you in a moment. The cash flow program, just as I was about to load on, decided it didn't want to play ball. So sorry about this, ladies and gents. Give me 2 minutes and we'll have this back on board. Live event today. Just while I'm doing that, Declan, just again, just run through their objectives if you can for me, and I'll have this open in 2 seconds.
Yeah, absolutely. Let me load those up on my screen. So the objectives we captured from Mr. and Mrs. Jones are at retirement. They want to buy a place in the Algarve, so a holiday home. Okay, so we're going to have to build and plan sufficiently for that purchase. Wanting to exit from the business in 8 years. John is age 52 at the moment, so we're looking at a timescale of 8 years to get both the business and his personal assets ready for completely walking away from work and never returning to the workplace. To become debt-free by retirement. John and Andrea do have liabilities at the moment, a mortgage of 500,000, some credit card debt and other personal loans that we're going to have to look to pay down between now and retirement. So an 8-year time frame there as well. Supporting their children. Laura's at university already, year 1, and Tom will be looking to go next year. And university, of course, is an expensive game. So they want to support them where possible. So we have planned for that. They're looking at around 20,000 per child. So that will cover both tuition fee, maintenance fee loans, and some discretionary expenditure. One of their other objectives is house deposits. It's very challenging to get onto the property ladder for young people these days. So they're budgeting 50,000 per child, age 25. They don't ever want to downsize. They currently live in £1 million property with a £500,000 mortgage. They don't ever want to release equity from that property. If a downsize does happen, again, we're not going to assume within the financial plan that equity comes into their plan.
Great, thanks, Declan.
Yeah.
Technology problems over. We've now got the cash flow system loaded for Declan to take us through.
Brilliant, no problem. Okay, welcome to Presswood Truth Cash Flow, guys. This is a dynamic and interactive modeling tool that we use with all of our clients. We start by inputting both current and future financial assets, income, expenditure, and then we input quite clever underlying assumptions which project a client's financial position looking forward. Then we model alternative scenarios, and we'll importantly also stress test the strength of their financial plan. Okay, so let's start with the first piece of data, is the net worth statement. Okay, here we are. This is John and Andrea's net worth statement in the cash flow software. The first asset class we have is unencumbered, readily realizable assets. That is liquid money. And in John and Andrea's case, it's only 30,000. Okay. The next asset class is business interest. This is the largest asset they have within their position. It's the value of the business plus cash in the business bank account. So that totals 5.5 million. Pension funds. Alison does have an NHS pension, but he's going to provide a secure income in retirement. So it's not a invested pension that we look like John's got with Standard Life. So we exclude that from the net worth statement. Here is John's pension valued at 300,000. Liabilities is the next section, the next items, and there's 4 items in here. There's a home improvement loan of 10,000, another loan of 7,000, the main residence mortgage, 500,000, and some credit card debt amounting to 3,000. So total liabilities, 520,000. And then land and property, which is the main residence, £1 million is their main residence value there. So 6.3 million is the total net worth as of today. We'll now look at the asset allocation breakdown, which is very important. As I said, their business interests represent, is quite substantially their biggest assets, 80% of their total net worth. Property, the main residence, £1 million is just under 15%. With managed funds, John's Standard Life pension, just under 5%. And liquid money, the 30,000 in the bank, not even 1%. Okay. Next, we're going to look at income. We work in tax years on this software. As you can see on the left-hand side, we're in the 22-23 tax year. And the income for the family is John's salary, pay-away salary, which is 9,000 for the tax year. Some bank account interest on the 30,000 in the bank, and dividend income from the company of 250,000. So total gross income for the tax year, just under 260,000. It's important to look at net spendable income. And this is what this tab shows us here. So 259,450 gross brings through 174,293 per annum for the family, which is around just 14,500 per month. The next item we'll look at is expenditure. We get our clients to complete detailed expenditure spreadsheets, which helps track ongoing expenditure. There'll be things that aren't always included, so that's why we do it. But again, in this example, we've grouped it into just total expenditure, and that is 85,000 for the tax year. On top of that, there is cost of servicing debt, which is the home improvement loan, just under 3,000. The main residence mortgage, around 38,000. Okay, so that totals 41,000. John's PCP arrangement with his BMW X5 that he personally pays for, which is 8,400. And again, some bank account interest reinvested on the system. We'll next look at the relationship between net inflows and net outflows for given tax years and then moving forward. So net inflows, 174,000 round figures, with net outflows, 134,000 for the tax year. This leaves an income surplus, assuming the figures are correct, of course, of around 40,000 for the tax year. And as you can see by those blue bars between now and John's age 60, there is an opportunity for surplus income to be put to good use. And we'll talk about what those strategies are a little bit later on. Of course, as they hit retirement, income will most certainly fall, and they'll be reliant on the assets they've built during their life, during their working life, to meet that retirement lifestyle expenditure. Okay. So if we now go we'll go back to the PowerPoint, and Matt will discuss now, I guess, what are the financial planning and economic assumptions, but also the client-specific bespoke assumptions. Over to you, Matt.
Thank you, Declan. So once we've taken the client through the first stage of the discovery program, we've inputted all the information onto Presswood. We need to create some assumptions. Now, some of those will be personal and they'll be linked to the objectives that John and Andrea have discussed with us, but some will be financial and economic. Now, as we know, things change. We're currently seeing inflation changing almost daily and interest rates are rising. So what we need to do is make some assumptions for those. However, financial planning is a journey, which is why ongoing service is so vital for any financial plan and any financial planning arrangement. The financial and economic assumptions we've made in this scenario are: taxation will remain the same, legislation remains the same, John and Andrea are in good health, they're UK resident and domiciled for tax purposes, state benefits remain at current levels, and no future circumstances occur. Obviously, we have built into the assumptions some changes, but there's none any others that we've not accounted for. Inflation is at 3%. We obviously know it's currently higher than that. However, financial planning is a long-term journey, 20 or 30 years, so we need to base that, but it is something that is reviewed. We've got national average earnings at 3%, pension fund growth rates at 5%, cash deposit returns at 1.5%, and property growth rates at 3%. So those are the financial and economic. Now we need to look at the personal planning assumptions. So there's quite a list. I'll read them for you. So we've got John is projected to retire age 60. He'll earn £259,000 between now and retirement, with a PAYE salary of £9,000 per annum and dividends of £250,000. Andrea does not currently work, and the assumption is that she does not return to work between now and John's retirement, thus nil income. We've got no future inheritances expected. John and Andrea will continue to pay down their main residence mortgage and any unsecured debt, clearing before John's age 65, however, ideally before retirement age 60. There'll be no downsides from this property, thus never realising any equity. This will remain your forever home. As discussed before, John's business will continue to contribute £500 per month into John's Standard Life Group personal pension, and the Standard Life pension will give John maximum tax-free cash, 25% of the fund value, and a sustainable income at retirement. Andrea has a deferred NHS defined benefit pension, which is projected to give £30,000 tax-free cash and £5,000 per annum from age 60. Both will receive full state pension age 67. We've assumed that they both live until 100 and that John sells the business in 8 years' time. For the planning purposes, however, this potential windfall has been excluded. John and Andrea are currently fully funding both children through university, costing £20,000 per annum per child. And we've also assumed that they will gift Tom and Laura £50,000 for a house deposit age 25 and £20,000 towards a wedding age 30. We've assumed that current annual expenditure is the £130,000, reducing to £90,000 in retirement due to a reduction in debt and university fees, and then falling to a further 50,000 at 80 as lifestyle reduces. This will obviously increase with CPI. John and Andrea will buy a holiday home in the Algarve, when John retires, for £400,000 in today's terms, which will then be sold at John's age 80. And finally, we've assumed that John will purchase a Rolex watch for £15,000 when he retires, and Andrea will purchase a Cartier watch. What we're going to do now is pass back over to Declan, who's going to introduce the bucket concept.
Thanks, Matt. Okay, I now want to share with you a crucial financial planning strategy. It's called the bucket. You can see it on screen in front of you. The bucket measures your liquid wealth, which is all important if you want to enjoy a financially comfortable lifestyle. And here is John and Andrea's. What we know is that they have money in their bucket already. It's 30,000 cash in the bank. This is their liquid capital, money they can get their hands on within 7 to 10 working days. And it's the money that we can use for financial planning. Now, of course, their house is not included in their bucket. Their house sits outside their bucket until at some point if they were going to downsize. But again, the assumption is they're not going to do that. Therefore, no equity will be released during the financial plan. Another thing that we can't include in the bucket is John's Standard Life Pension Fund. However, at some point in the future, as Matt said, 25% of the fund value might be released as tax-free cash as an inflow into the bucket. And then, of course, we'll maybe turn on a tap for income, a sustainable income or a taxable income from the pension, and this will be a future inflow into the bucket. Another thing that can't be included is the value of the business, Widget Productions Limited. John has spent many years building up the business, putting heart and soul into it, but until that business is sold, it stays outside the bucket. Now, as you can see, wealth is building inside and outside of the bucket. The good news is that there's a regular inflow, and the regular inflow is salary and it's dividends from the business, and potentially a windfall when John comes to sell the business in the assumed 8 years' time. At some point in the future, two state pensions will start flowing into the bucket as well. Okay, and of course, Alison's NHS pension scheme as well. Now, this all looks great, doesn't it? But if there is one problem, there's a tap. And on the right-hand side is the cost of their current lifestyle, estimated to be 130,000 per annum. Now, this tap will continue until retirement, and then that tap gets turned off and it's replaced with a different tap. And that different tap is the retirement expenditure tap of 90,000. Okay, now at some point in the future, that tap will turn off, and this is where life gets a little bit more straightforward. We call it later life spending. That might be age 75, age 80, or even age 85. But again, this is where life gets a little bit more straightforward, expenditure falls, and the assumption for John and Andrea is that drops to around 50,000 per annum. On top of those taps, those ongoing expenditure taps, there are one-offs included in clients' financial plans, and that is big expenditure items, big gifts. And in John and Andrea's case, that is property deposits for the children aged when they reach age 25, wedding funding, and the Algarve holiday home purchase. Our job as chartered financial planners is to help not only identify, but then manage what's going to happen to John and Andrea's bucket. And typically there's three things. It will run out. They'll run out of liquid money, and that is the red line you'll see there. It'll overflow, which of course is disadvantageous as well. They've worked exceptionally hard to accumulate resources for their retirement, and are they not spending enough, or they're not planning well enough, and essentially their estate will pay too much inheritance tax on second passing. Our job is to find that perfect balance, the optimal position. That is the green line. That is where they can meet all of their lifestyle objectives from their liquid money, crucially not running out of liquid funds, but also ensuring they don't die with too much. This is what we call real wealth management. We want our clients, again, to not have fear of running out of money or dying with too much. Now, let's take a look at John and Andrea's financial projections, their bucket, on the cash flow software. So this projects forward the £30,000 and how that changes over time using the assumptions. As you can see on the cash flow software in front of you, they're projected to run out of liquid funds at retirement, at John's age 60. Between now and age 60, the 40,000, circa 40,000 is the income surplus, and that is building up between now and retirement. However, they run out of money. Now, the question is, how much do they need to sell the business for to remove that vulnerability? Because that currently is excluded from the projections. The cash flow software will work this out for us now. Circa 1.7 million net of tax at age 60. And this is the new projection that you can see now with the vulnerability removed. This provides business owner clients with real peace of mind of what they need to sell their business for. The second question might be, how much income do I need to draw from the business, put into personal reserves between now and retirement to stop the liquid funds running out? Between now and, of course, when John retires, which is his assumed age 60. £310,000 per annum additional income. Again, you can see the blue chart there, the change projection with the income now assumed. This is the power of cash flow financial planning. Now, let's go back to the PowerPoint and let's look at the underlying strategy that we would be looking to recommend for John and Andrew to improve their financial position between now and retirement. Okay, now firstly, please note these are high-level strategies, and if looking to take any action that we'd advise you seek specialist advice from a professional about your bespoke situation before implementing any of them. So the number one strategy that we would recommend is that John brings Andrea into the business, his wife. We would advise that where possible, she joins the business and fulfills a role, meaning that she can become an employee and a director. Once this has been established, John and Andrea should increase their base salaries to the personal allowance, currently 12,570, and this would save corporation tax for the business as well. Dividends could then be split equally between John and Andrea, £125,000 per annum each, therefore reducing the amount of tax paid and increasing joint net income. That is number 1 and 2 covered. Number 3, introducing alphabet shares. Alphabet shares are the most common example of different share classes seen in small to medium enterprises. The benefit is that each class can be given different rights. For example, weighted voting rights or preferential dividend payments. An example of class rights for alphabet shares is the payment of different dividends. If 4 shareholders each held one ordinary share in the business, they would each have an equal right to the dividend. However, with the alphabet shares, it doesn't have to be the case. Alphabet shares get around this by creating what we call weighted dividend rights. So we would suggest establishing a separate trading or family investment company and then designating 5% of Widget Production Limited shares into this arrangement. Between now and retirement, £50,000 of dividends would go in each year and fund this arrangement, extracting money from the business, a key objective, ready for retirement. This money would then be invested in that arrangement, and we would assume a growth rate on that for the projections, which then would be drawn down as a retirement, as an income, in retirement. We would suggest creating those alpha shares and establishing shareholders to be as follows: 51% to John, 5% to the trading/family investment company, 34% to Andrew, his wife, and 5% to Tom and 5% to Laura. This would also enable dividend payments to be paid out to their children, who now own alpha shares, which can be used to cover student education funding, which they're funding out of personal reserves at the moment anyway, increasing tax efficiency and reducing their personal expenditure. Number 4, pension funding. Another key and important strategy is pension funding for both John and Andrea. It's a method of throwing money over the wall, extracting money from the business for their personal reserves. John should look to utilise and maximise his annual allowance, including potential carry forward. We would advise that Widget Production Limited should maximum fund his standard life pension arrangement between now and retirement. Now, John's currently receiving around £500 per month from the company into his pension arrangement, and has done. This has been historic. It's been going on for a while now. So this would mean, looking at approximate figures here, that he'd have unused annual allowance of around £34,000 for the current tax year, and carry forward, going back 3 tax years, of £102,000. So the assumption in the new projections will be that the company make a one-off employer pension contribution of £136,000 for this tax year, and moving forward between now and age 60, £40,000 for John. This would bolster his personal pension arrangement for retirement, therefore increasing tax-free cash, pension income, reducing business profits, so the liability to corporation tax reduces, And if structured correctly, the Standard Life pension arrangement, pension benefits are then starting to build up in an IHT friendly asset. So if they're not used, it can be passed tax efficiently to the children. A personal pension arrangement should also be set up for Andrea, whereby the company, again, now she's in the business, working for the business, they could also fund an invested pension arrangement for her, maximising annual allowance between now and retirement, enhancing their joint pension assets. Number 5, increasing investment risk on pension assets. Assuming John and Andrea have a suitable attitude to risk, by increasing exposure to equities, the engine room of the portfolio, within their invested pension arrangement, this has the potential to increase long-term investment returns. As they are circa 8 years away from retirement, they have sufficient timescale to withstand the increased market volatility that would be experienced from an increased risk portfolio. But it would meet their objective of building personal assets and increased investment returns ready for retirement. In the original base scenario you've just seen, we've assumed a 5% net investment return on John's Standard Life pension. We've now increased that in the new scenario we'll show you to 8% net, now that he's adopted a new strategy with a higher risk portfolio. Number 6, alternative investments. Another consideration is pursuing alternative investments that offer tax relief. An alternative investment is a financial asset that does not fall part of conventional investment categories, namely stocks, bonds, typically an ISA or a pension. There are other forms of personal financial planning that should be considered before, most notably maximising pension funding. However, these alternative investments cannot be funded directly from the business. So John would need to extract money from the business, maybe in the form of a dividend, which would of course be liable to dividend tax. He would then invest the proceeds into a VCT, Venture Capital Trust, or an EIS, Enterprise Investment Scheme. And on doing so, he would receive 30% income tax relief. This is capped at the amount of tax he pays, thereby offsetting dividend tax and enhancing money outside of the business. We would suggest that John directs circa 30,000 into a VCT between now and retirement. They assume to achieve an 8% net growth. And again, this could be drawn down in retirement, another further income source, further diversifying his personal invested assets and reducing his tax liabilities. Number 7, protection, restructuring protection products. John currently has a personal life policy that he pays for personally. It's a £2 million sum assured, and it's for the benefit of Alison in the event he was no longer here. We would recommend that he switches this, cancels the policy and takes out a relevant life plan. Now, why? Relevant life plans are more tax efficient in this situation. The premiums are not usually treated as a P11D, benefit in kind, meaning that the employee won't pay income tax on the premiums, and both employer and the employee will avoid paying national insurance on the premiums. As long as the premiums are wholly and exclusively for the purpose of the business, they should be also allowable business expense for the employer. Benefits paid through the relevant life plan trust should also not form part of the estate for the employee in relation to inheritance tax. Another protection policy, just quickly to touch on, is ensuring that our clients have adequate protection, not in the event of death, but in the event of them being unable to work due to long-term illness or disability. So we would recommend that John takes out an executive income protection plan to cover this vulnerability. Number 8, the final strategy we'll cover today is company car. John currently pays £700 per month for his car through a PCP arrangement. One consideration would be that he sells his current car and instead buys a brand new electric vehicle through the company and claims the sizable tax benefits offered by the government. Furthermore, his personal motoring expenditure would fall. The tax benefits include 100% capital allowance, meaning that if John was to purchase, let's say, a model Tesla Y with a value of 65,000 through the company, he would save around £12,350 in corporation tax. He could also claim 5p per business mile to contribute to the cost of electricity, and John would save £700 per month personal expenditure and would only pay 1% benefit in kind for the electric car on his tax return. Now, with all these strategies implemented, what does John and Andrea's cash flow projections look like? we have now just overlaid the new strategy. So the black line is the current position, the base scenario. They've run out of money at age 60. The orange line is the newly adopted strategy. As you can see, between now and John's retirement, they build assets, personal assets a lot. The line's a lot steeper, and that's because they're extracting more money and putting it into invested assets. Of course, during retirement, they are drawing down on their liquid money, but they've got more invested assets to draw down on. So importantly, they don't run out of money, and it still doesn't assume any business sale. A value is realized from business sale. So this is the power of cash flow financial planning. We can put real life strategies and scenarios and demonstrate the impact of them and stress test, I guess, how strong they are for clients. Nick, over to you for pre-sale business planning now.
Yeah, thank you, Declan. Let's just get my screen back on. Here we go. Yeah, thank you for that, Declan. Again, just to stress, what we try to achieve with all of our clients is to achieve financial freedom without having to sell their business. Now, of course, it should and may be an objective to be able to sell the business, but ultimately we want to be fairly cautious and prudent within our approach, and to demonstrate how much our clients need to generate from their business through remuneration to not have to depend on selling the business. And we feel that's quite important. We call it throwing money over the wall, as Matt mentioned earlier. But if we are looking at selling the business, just very quickly on these 2 points before we come to questions, a couple of pre-sale planning opportunities business owners do have. The first one is maybe putting some existing shares within the business into a family investment company. Again, I must stress this is complicated, and advice should be sought from a tax professional that's expert in these areas. But again, some things our clients have done in the past is putting some of their shares in their trading company into a family investment company. So when the business is sold, there's no capital gains tax payable on the monies received. Instead, the money goes into the family investment company, which then can be used obviously to provide for income for the family in the future. Obviously it's subject to the normal taxes, corporation tax and dividend tax, which needs to be managed. But there are also some potential IHT benefits depending on the share structure. Another popular way of mitigating tax is to put some shares in the company prior to sale into a family trust or a discretionary trust. And again, the reason for this, when you own a trading business, it's exempt from inheritance tax because it receives business relief. But as soon as the business is sold and that business turns into cash and it's sitting in the business owner's estate, it's then liable to inheritance tax. So by placing some of the shares into trust prior to sale, on sale, the money generated goes into this trust and therefore is outside of the estate and therefore not liable to inheritance tax. There's of course more to it than that, but these are just two high-level options that you may want to consider and maybe speak to your own accountants or legal advisors about. So from our perspective, what we've tried to cover here, and again, it is a whistle-stop tour, so apologies for the amount of information we've popped into this webinar this evening, but ultimately we've tried to demonstrate how we work with clients and ultimately the benefits of financial planning and the financial strategies that can be incorporated into plans. And it's so important to, in essence, plan and make sure you look at your business as a vehicle to achieving financial independence for yourselves. We have had some questions from this morning's sessions that I can actually read and ask. But what I would ask, we've got a few minutes now for questions. There is a Q&A box just down the bottom here. So maybe while you're thinking about some of those questions, I'll ask one that was asked this morning. And I think it's a pretty interesting one in terms of how we value businesses or how we value the business for the Mr. and Mrs. Jones. So could I ask you to answer that one, Matt, first, while we perhaps wait for some other questions to come in?
Of course, yeah. Thank you, Nick. So we've used an acronym called EBITDA, which is a standard measurement of a business's performance that banks and other financial institutions and even the business owner themselves can use to value the business and their profitability. It's an acronym, as I said, and it stands for earnings before interest, taxes, depreciation and amortization. Depreciation is the depreciating value of tangible assets, and amortization is the depreciating value of intangible assets such as copyright and things like that. So if we look at an example, it might be quite a good idea for Widget Productions Limited. So John's got a net profit of 1 million, interest paid of 100,000 on borrowing, taxes paid of 400,000, and then depreciation and amortization of 350,000. So that gave us an EBITDA figure of 1.85 million. And then what we've done is we've prudently multiplied that by 3 times to give us the value that Declan showed you earlier on Presswood. It's very prudent given that some businesses sell for considerably more than that. But what it does allow John to do is gives him a great way of valuing his business, measures operating profitability and gives a snapshot of the net income. And what it does do from a company possibly looking to buy other companies is allow them to compare apples with apples based on 2 businesses that they might be interested in purchasing.
Thanks, Matt. I mean, EBITDAs are quite complicated, but any business owner, I would recommend you understand what your own EBITDA is to understand the value of your business, and just measure that really year on year. So again, we'd recommend you all get an EBITDA valuation of your business. Most accountants can produce that for you. Failing that, we can do it fairly straightforward as long as we have the information available. We had a question coming from Mike. Hi, Mike. And the question he asks is, how often do you advise people to review their plan? I'll answer that one, and guys, you may want to come in as well. But typically, Mike, when we create an initial plan, it's quite comprehensive. So after the initial plan's created, we advise we revisit that after 6 months, and then at least annually thereafter. But again, if there are some significant decisions, if there are some significant changes in circumstances or opportunities, we advise our clients to approach us and discuss those with us to see how it impacts upon their plan. Ultimately, we've invested a lot of time and effort, as of our clients, to create their plans. It's important that we keep this on track. So minimum annually, often more frequently in the initial years, and certainly if there's a change of circumstances. If Declan, you'd add anything to that at all?
Yeah, I'd agree, absolutely. Initially, there's a lot of things to often cover, to source issues and opportunities to seize upon. So absolutely, minimum for us, I've reviewed the plan twice in the first year, and then most certainly annually moving forward. But we have check-ins throughout the year to ensure the plan stays on track. There's lots of things that can cause it to veer off track. That could be market volatility that we're going through now. That could be business change. That could be changing personal circumstances. So we're constantly tinkering with the plan to ensure that it remains on track.
Absolutely. One other question. I think we've got time for more, but if there's any other questions, we're happy to stay on. And again, Declan, perhaps you can answer this one and I can chip in afterwards. How do you typically onboard a new business owner client?
Yes, no problem. So the first stage would be to go through the Financial Sense Discovery Program. But again, we do separate the business owners because we understand there's 2 entities we're looking at here. But I think someone's personal life and someone's business as well. We're trying to marry the 2 together. So we take a lot of time to understand the business owner, what his hopes, aspirations, concerns are. And we build a financial planning strategy that aligns to the business about how we can meet those objectives. That might be a business exit, that might be an MBO, it might be going to market. So we build all those stress test scenarios and plans in. So we get to know you in all the detail, we build a plan, and then we implement the plan. Along with that, we also analyze and research your products, and products might be pensions, investments, things to do with the business. And again, our technical team that we've got in-house look at that, and then we make recommendations. So it's a series of meetings. I'd probably say something between 3 to 5 meetings to properly onboard a business owner client. And we build a comprehensive bespoke financial plan for the business owner.
Yeah, thank you, Declan. There's not much I could add to that really, but ultimately it's sitting down, understanding the world of the business owner, you know, their interests, their family, their hopes and aspirations, understanding the business, of course, and what a great life looks like, and then costing that with the financial plan and the cash flow strategies that you've seen there. One other question. I've seen on your website you have a planning app people can fill in. Is that a simple version of the planning app we've just seen? Yeah, great question, Mike. We do have a basic planning app that clients and prospective clients can use, so you can get a taste of financial planning. It's called This Is Money, and it provides truth about money. So you can basically put in your incomes, your expenditures, and indeed your assets, make some assumptions on inflation, investments, etc., and project this forward. So it's a very basic tool for you to create your own plan using the cash flow models that we've demonstrated there to you. So yeah, great call that, Mike. Thank you for raising that. We do have that facility for people to use. If anyone would like access to that, then please drop us an email, info@henwoodcourt.co.uk, and we can point you in the direction to that. So it's info@henwoodcourt.uk. I don't think there's any more questions that have come in now. So thank you for the questions that we've had. Again, apologies for the technical glitch we had 20 minutes or so ago. I really hope that's been a useful exercise for everyone attending this evening, and it gives you a flavour for what the business owners should and could be doing in relation to managing their own finances and using their business as a ticket to their own financial freedoms. So thank you all, and have a good evening.
Thanks, everyone.
Thanks, everyone.